Founders tend to treat valuation like a negotiation. They think it's about confidence, storytelling, or how big they believe their company can become. But institutional investors don't think that way. Valuation to them is math, risk assessment, and comparables. Narrative matters, but only as a support for financial fundamentals. Today we're going to dive deep into valuation. Revenue multiples, EBITDA multiples, discounted cash flow analysis, market comparables, risk adjustments, valuation caps, how different industries are priced, why service-based businesses trade differently than tech, how to justify a valuation to investors, and how investors use valuation to protect themselves. Let's start by clearing up the biggest misconception. Valuation is not what you think you're worth. It is what the market is willing to pay. Valuation is market-driven. It reflects risk, growth potential, profitability, predictability, competitive landscape, management quality, capital efficiency, industry benchmarks. Founders often overvalue potential and undervalue risk. Investors do the opposite. Real valuation sits between these two perspectives. Primary valuation methods. Number 1, revenue multiples. Used for companies with strong revenue but weak or negative earnings. Tech companies often use revenue multiples. Service companies sometimes do. Typical revenue multiples vary widely. SaaS, 5x to 15x annual revenue. Manufacturing, 1 to 3x. Service businesses, 0.5 to 1.5x. Healthcare, 1 to 3x. E-commerce can be 0.5 to 1. Revenue multiples depend heavily on growth rate and margins. EBITDA multiples. This is the most common method for established companies. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It shows operating profitability. Typical EBITDA multiples, small service businesses 3 to 5x. Mid-market service businesses 5 to 8x. Healthcare and specialized services 6 to 12x. Software companies 10 to 20x. Large enterprises 8 to 15x. EBITDA multiples reward predictable profits. Discounted cash flow. Discounted cash flow calculates valuation based on future cash flows, discounted for risk. DCF forces founders to answer, how predictable is my revenue? What will cash flow look like? How risky is the industry? What is the fair discount rate? Investors love DCF because it exposes unrealistic assumptions. Market comparables. Investors compare your company to similar companies in the industry. If other service companies sell for 4x EBITDA, you must justify why you deserve more. Narrative alone is not enough. You need stronger margins, stronger contracts, stronger growth, or stronger competitive positioning. Risk adjustments. Investors discount valuation based on risk factors. Customer concentration, weak management team, unpredictable revenue, poor systems, founder dependence, low margins, legal issues, heavy competition. Each risk factor lowers valuation. This is why operational maturity improves valuation. Why service-based businesses often get lower multiples. Service businesses depend heavily on people. People introduce variability. Turnover disrupts operations. Margins fluctuate. But service companies that create recurring revenue, contract-based revenue, systematized delivery, training infrastructure, documented processes, strong middle management can push valuations significantly higher. Operational discipline creates valuation leverage. Valuation in early stage capital raises. In Reg D early raises, valuation is often negotiated. In Reg CF or Reg 8 raises, valuation is disclosed publicly. Early stage companies may justify valuations through market size, traction, customer base, revenue growth, intellectual property, strategic partnerships, but investors still want grounding in reality. How investors protect themselves through valuation. Investors use valuations to control entry price. manage dilution, reduce downside risk, increase return potential. Lower valuation equals a safer investment. Higher valuations equal higher expectations. Founders who overvalue their company early often struggle in later rounds because numbers fail to catch up to expectations. How do you justify a higher valuation? To justify it, you need strong revenue growth, strong margins, predictable recurring revenue, large addressable market, strong governance, clean financials, and a clear capital allocation strategy. Investors pay premiums for clarity, stability, and scalability. The valuation reality check. If you walk into a room saying you're worth $10 million, investors will ask, based on what? What's the EBITDA? What's your growth rate? What's the multiple? Where are the comps? What's the risk? What's the potential for your exit? Valuation must be defended with facts, not aspirations. The key takeaway: valuation is not a feeling. It's a synthesis of risk, performance, comparables, and future potential. Investors don't fund assumptions. They fund predictable outcomes. Companies that understand valuation fundamentals present themselves as credible, investable, and scalable. Companies that ignore valuation fundamentals struggle to raise capital, struggle to negotiate the terms, and struggle to exit.